All right, thanks so much. It's awesome to be here. I live out in Vancouver, but I'm actually from Toronto. So, coming back here, walking around, it's all like a trip down memory lane for me. And I lead up the Climate Justice Project at the CCPA, which is mostly focused on BC, but I feel like a lot of my own impressions were kind of shaped by growing up in Toronto. I lived out in the West End, and I took the subway every day when I was younger, and I lived near High Park, so I think my sense of green spaces was really shaped by growing up around that park and spending a lot of time there as a kid. And my sense of sort of class struggle and dynamics was shaped by growing up in a single parent household and getting sent on scholarship to Upper Canada College. So I kind of feel like a lot of those things are kind of wound up in my work that I'm doing now, and historically with the CCPA. Back when I was a teenager at UCC, I was really I just wanted to be like my peers and have a lot of money and have a big house and all this stuff. So I was really interested in finance and thought I might want to be an investment banker for a few years there. And so my path ended up being very different. I didn't know what an investment banker was. I just knew that they made lots of money. So I was like, yeah, that's what I want. Instead, I kind of drove down the road of becoming an economist and got involved in progressive stuff and ended up working at the CCPA, and here I am all these years later. So I kind of get to close the circle a little bit by talking about finance. But most of what we've been doing at the CCPA is looking at how we transition from an economy that's very addicted to fossil fuels to one that's essentially zero carbon a couple decades down the road. And so I guess the premise of where we are at right now is this. I mean, will this type of drama continue to unfold year after year? Where countries like Australia and Canada are shamed internationally in these negotiations. The world gets warmer, and we see sort of ever more extreme disasters. I guess I'd argue that this can't continue forever, or much longer, in fact. Obviously, things are not looking great. The idea of carbon budgets was being talked about by a study by the Potsdam Institute. Meinhausen is the main author, looking at what's the total ceiling on carbon emissions before we pass that 2-degree threshold. That was picked up a couple years ago by a group in the UK called the Carbon Tracker, and they basically put forward this thesis about a carbon bubble. That is that if you look at that science-based carbon budget of, they said 565 billion tons or gigatons of carbon dioxide. It's a couple years down the road now, so we're probably down to about 500. No matter which way you slice it, that is vastly smaller than the proven fossil fuel reserves of coal and oil and gas worldwide. And they concluded that 80% of those reserves needed to stay in the ground if we were to have a reasonable shot at making the 2-degree target. And they said an 80% chance of staying below 2 degrees. So there's really not one single carbon budget. There are kind of multiple carbon budgets depending on the amount of risk you're willing to accept around that 2-degree target, and ultimately whether you even agree if it's 2 degrees or 2.2 degrees or 2.8 or 3. So there's a lot of different ways you can slice it, but I think it's significant that just in September, when the latest IPCC report came out, the Intergovernmental Panel on Climate Change, they have now called for a global carbon budget, a ceiling on carbon emissions. And they come up to a different and larger number, partly because they lowered the probability of getting to 2 degrees. So it's not 80%, it's like 66% in what they were publishing. And there's a few different assumptions around land use emissions and non-carbon dioxide emissions. But nonetheless, it doesn't really change the basic equation in terms of the magnitude of proven reserves relative to some notion of a carbon budget. And if you look at the IPCC numbers, basically works out to about 30 years of emissions at current levels, if you look at the carbon tracker / Potsdam numbers, it's more like 16 or 17 years of emissions, and so it's pretty serious. One of the things I've been looking at more recently, like in the report I did, and following the IPCC, is what does this mean for Canada? Like, what's kind of a plausible share of that global carbon budget for a country like Canada, which has relatively small population, but larger than average GDP per capita, and it's essentially the same range. You get a fairly small carbon budget if you look at Canada's share of global population and you base it on that. You get a larger number if you base it on gross domestic product. You get a slightly larger number than that if you look at Canada's share of the total reserves. And so even if you take the largest number there, which works out to like 30 gigatons of carbon dioxide equivalent, that's still a third of our proven reserves, which is about 97 gigatons. And if you look at the category above that, which is sort of proven plus probable reserves, which is like 174 gigatons, then 30 out of that is that much smaller still. It's even worse for Canada because the reserves that we have tend to be weighted to the most expensive and dirtiest fossil fuels around. So we have a lot of coal and we have a lot of bitumen. And those really dominate the numbers in terms of reserves for Canada. So in any kind of carbon-constrained regime worldwide, you would think that it's those high-cost, dirty sources that are going to be targeted first. I mean, you may have natural gas in some respect as a transition fuel to get where we need to get, and I think there's a lot of debate around that with fracking and methane leakages and LNG developments and all of that. But certainly, bitumen and coal, I think, are going to be very much targeted. And of course, this relates to Canada's overarching economic strategy right now, which is to further expand and exploit those fossil fuel reserves for export. So, that's kind of the Canadian version of the sort of do your math, which 350.org has been putting out. So you're probably relatively familiar with that. So the report that we did, Canada's Carbon Liabilities, tries to add value to that by putting some numbers to it. So I had a great student researcher who helped build this database of fossil fuel companies operating in Canada. So we got based on certain thresholds, we got 103 publicly traded Canadian companies, all listed on the Toronto Stock Exchange. And we were also able to get another 11 global corporations who have subsidiaries operating in Canada with substantial reserves. And we looked at their financial data, their revenues and assets and market capitalization. And we then got information through the Carbon Disclosure Project about their reserves at different categories and different types. And we said, okay, look, if you have these certain amount of reserves in the ground, there are emission factors. We can convert that into potential carbon dioxide that will go into the atmosphere because that's the business model. And more than that, we know that putting a ton of carbon dioxide into the atmosphere causes a certain amount of damages. Now, there's a range of estimates about what that actually is, so we took a range. But putting that that business model, taking carbon out of the ground, putting it into the atmosphere, causes damages to third parties, who are basically not the buyer or the seller of those fossil fuels. Those are the people in the Philippines or people in Bangladesh whose homes get eroded by rising sea levels and this stuff. So it could be happening now, it could be happening down the road. And we basically multiplied that all together to come up with this concept of carbon liabilities. So, this is essentially the potential damages that will be caused by business as usual with this industry. And I think that interfaces really nicely with the study that Cam mentioned, where these 90 companies have caused 2/3 of the global warming emissions to date. And we start to get at some issues. Well, if you can actually pin it back to particular companies, and we know that those are causing damages, then there are potential legal liability challenges down the road. Now, I'm not a lawyer, so I don't know exactly how that would play out in a domestic court or internationally or somewhere else. But I think that's another element of risk that's really important to think about by going down the very carbon-intensive road that we're on. The financial markets themselves, I think, there's systemic risk associated with holding on to these fossil fuel stocks. In the same way that when the housing bubble popped in the United States, a lot of pension funds and investors thought they were holding these AAA securities when in fact they turned out to be toxic subprime junk. And I think fossil fuel stocks could be the next toxic junk. Simply because their business model is about extracting and exporting this carbon, and we know that we can't go there, nowhere near to the amounts available. So in my paper, I look in particular at the implications of that for pension funds. I think pension funds are of particular interest because housing is the #1 asset for most middle-class households, but the second most important asset is the rights to future income through a pension fund. So there's 6 million Canadians who are pension fund beneficiaries, and if we do have this collapse in fossil fuel prices, because of a new carbon constraint regime that comes in place, then they're going to be holding on to these assets. And so we argue that there are important moral arguments that can raise it, to be sure, but on a straight economic case, the fiduciary responsibility, the responsibility of the trustees of those funds to maximize the returns for all beneficiaries is not being upheld if they are not fundamentally looking at climate risk. And I think this is important for pension funds because they have to look not just at maximizing returns for their existing retiree base, or people who will be retired 5 years from now, but they have to treat all of the beneficiaries equally, including the 22-year-old who just started working there and paying into the pension plan. So that 22-year-old isn't going to be retired for more than 40 years. So can they say that 40 years down the road, they are making wise investment decisions on behalf of that person? The key thing is for them to have to wrestle with those questions and try to answer them. Because right now, the pension fund industry, institutional investors in general, have been ignoring climate risk. They look at inflation risk, currency risk, the risk that there'll be a coup that topples a government and they lose their assets, but they're not fundamentally looking at climate risk, and we're trying to make them do that. About a month ago, there was a group of pension funds and other institutional investors, about 70 of them, which came together. They have about $3 trillion of assets between them, and they wrote an open letter to major oil and gas and coal companies, laying out the same math as I have and asking them, well, what are your plans? How are you dealing with this math in your operations? What does this mean for your capital investment plans? So, putting some pressure on those companies and essentially putting them on notice. So, all of these things I think are related to the divestment campaign in an important way. I think some of the arguments you'll hear coming back at you are, one is around this, fiduciary responsibility. I think that's more soft constraint when it comes to a university endowment. But certainly you hear the argument that, we shouldn't just divest, we should engage with those companies and talk to them and present them with facts and figures and make them see the light. I would argue that has not been a successful strategy so far. I think you'll also hear this framed in terms of the existing industry model, which is called ESG, so environmental, social, and governance issues. And those tend to be cast in more moral arguments. We are concerned that mining companies are responsible for murder and rape in Latin America, and we should not invest in those companies. Those are important and legitimate arguments. but it gets you into this box of saying, well, are there other, companies we can invest in? Well, we'll have kind of a comparable rate of return and all that sort of stuff. And I try to, use the carbon bubble argument to flip that on its head, that the moral arguments are important, but there's this kind of fundamental economic case here, and if you're not looking at this stuff, then you're putting the assets you have fundamentally at risk. Last point is that I know you're focused on the endowment at U of T, but I wouldn't think, and I think that may be a good target at first to win on, but there are broader issues around this as well. Pension funds is obviously one as well, and I think that to the extent that you can get faculty raising these questions and challenging the pension fund trustees, I think that also contributes to the movement that we want. And I think there are other kind of pernicious corporate influences on campuses as well, in terms of endowed chairs and buildings and departments. And we should be challenging that corporate presence as well in terms of how it shapes the mandate of universities and what they do. But the important point, and it's one great thing about universities, is that it's universities support science, and the science supports the reason why you guys are all sitting here today. So that's my little spiel. The paper that we have is available off of our website, policyalternatives.ca. We also talk about some transition strategies of how we get from this to where we want to be. But I'll leave it there, and happy to hear what you guys have to say, or happy to try and answer any questions that you might have. Thanks.